When I build my high yield portfolio, I generally take a long-term perspective. And by that I mean I do not chase the latest hot sector or completely reposition my portfolio based on my expectations for the near-term macroeconomic environment. I'm not a macro analyst primarily. It's not where I spend much of my time. And so I don't base my investing strategy off of macro calls. That being said, when I redeploy capital or invest new capital, whether it be from a position I just sold, I'm recycling it into a new position, or dividend income or freshly earned income that I'm bringing in from outside my portfolio, whatever it is, I do take some macro factors into account while also evaluating it against value opportunities. So basically, wherever I see sectors that I think are most opportunistic at the moment, given my understanding of the macro situation and where the industry's headed, and within those sectors where I find the best bargains, where I find value, that's where I generally will invest my freshly earned capital. And so in today's video, I'm going to explore a hypothetical scenario where I have $100,000 to allocate here in September 2024, and I'm going to share you 5 areas where I think that it could be most opportunistic to deploy that capital, as well as individual opportunities in each of those sectors that I think are most opportunistic right now. Before I get into the video though, I'm getting really close to 3,000 subscribers. If you could help me get there by clicking the subscribe button, as well as liking this video, it would really help me grow my channel and get more distribution on video. I'd greatly appreciate it. Thank you very much. Okay, so the first area where I would allocate this capital is precious metals, and there are several reasons why I would do that. First of all, history has shown that whenever the Federal Reserve pivots from rate hikes to rate cuts, typically gold and silver soar higher. We saw this especially back in the wake of the 08-09 financial crisis, but we even saw it other times in history, and even fairly recently in the 2018-2019, the Fed started thinking about hiking and then they cut back, and that caused it to move higher. We also saw gold move a bit higher in the wake of the COVID crash and the Fed cutting there. And so, we're seeing that already this year. When the Fed clearly had ceased raising rates late last year, gold really took off. Silver's had a great 2024 as well. They continue to seem to be headed higher. And so with the Fed about to start cutting rates, potentially cutting them in earnest, that's only going to make gold and silver more attractive. Another reason to be bullish on them is that central banks have been loading up on gold recently. There's an increasing de-dollarization of the global economy. That bodes very well for gold, not so much for the US dollar. Another big reason is the runaway spending in the United States and other major governments. Again, that's very bullish for gold and silver, which cannot be printed. You have to work hard. It's expensive to mine them. And again, it's the favored money of central banks and thousands of years of economic history, whereas dollars, every fiat currency in history has inevitably gone to zero. Seems like the dollar is headed that direction as well, maybe slowly, maybe quickly, who knows. But regardless, I think gold and silver are great long-term bets. And so for those reasons, I'm very bullish on them. A final reason is simply that, okay, there's a large amount of geopolitical risk in the world. Russia is continuing to wage its war in Eastern Europe. Iran and Israel are on the edge of conflict at any time now. And the biggest one of all is China could go to war at any moment with Taiwan or the Philippines, or some other major conflict in East Asia involving China could erupt. And that would cause major disruption to the global economy. And likely in such a scenario, gold would go through the roof. Silver likely would follow at some point. And there you have it. It makes that a great hedge for your portfolio. And so for that reason, I'd probably put about at least 20% of all my fresh income or fresh dollars to redeploy into precious metals. And there are several places I would deploy it right now. One is simply to gold bullion, whether that be a low-cost ETF like BAR, or even putting it into something like Monetary Metals, which is a fund where you can put your money into it, buy actual bullion, gold and silver. They store it for you for free. And you can even lease it out on a fully insured basis to jewelers and other people who use it as part of their business as a hedge for them, and they pay you a yield. I'm getting 3.5%, 4%, 5% yields on my investments through these leases. They're very conservatively structured, and you continue to have full exposure and full ownership of your underlying bullion. So that's where I'd put probably about 5% of it. Another 5% I would probably put in a more liquid options capable ETF like GLD. And then another perhaps 2.5% into SLV, which is the silver version. And both of those have very low options, big ass spreads, a lot of liquidity. You can sell covered calls against them to generate income while still having that nice liquidity. I do that quite a bit. I think those are great ways to invest in precious metals while also getting some good income. I put another 5% into blue chip gold miners. My favorite right now is Bear Gold because I think it trades at a huge discount to its peers like Newmont, Agnico Eagle mines. Has similar quality mines, strong management, strong balance sheet, pays a dividend, buying back stock opportunistically. Now, the main difference there is they do have more geopolitical risk because they're concentrated in places like Africa, which are a little bit more geopolitically risky. But again, they have a track record of doing that very successfully. They have a very promising copper pipeline as well. And so I see a lot of value in Bear Gold. So at least I'd put some into Bear Gold, maybe the rest in the GDX. Depends on the individual and what you're going for. Finally, I'd probably put another 2.5% to round out the 20% in a low-cost ETF like SIVR, or again, put it into silver bullion at Monetary Metals, which would be my personal first choice. But again, some people don't like to have a separate investment account and go through all that hassle. SIVR as an ETF, that's just fine. You just won't get a yield from it, and you do have to pay some storage expense via an expense ratio. Okay, the next place I'd put another 20% would be into Midstream. I'm a big bull on the Midstream sector. I have been for several years now. It's done great, but I still see a lot of value there. There are a lot of attractive yields, very strong balance sheets, long durated contracted cash flows or even regulated cash flows for a lot of midstream businesses. So I think it's well positioned to weather an economic downturn, while also those contracted cash flows, those regulated cash flows are going to increase in net present value when interest rates fall. But, the balance sheet's strong. They also tend to benefit some from inflation. So wherever the economy goes, I think Midstream is a great all-around investment. My favorite Midstream right now is Enterprise Products Partners. I've done videos on them in the past. There's so much to say about them. That's great. But the bottom line is they offer an over 7% distribution yield right now. That's very well covered by distributable cash flow, about 1.7 times. They have one of the lowest leverage ratios, and they have the highest credit rating of A- in the entire midstream space. They're growing their distribution at about a 5% CAGR and expect to do so moving forward. There's a chance in a couple of years of a major catalyst from either a special distribution, accelerated distribution growth, and or major jump up in share repurchases, unit repurchases. So between all that, insiders own about a third of the partnership. Great long-term track record of deploying capital prudently, generating attractive returns for unit holders. I can't think of a better, honestly, income stock right now to buy. And so I would deploy more capital there right now, especially because the unit price has kind of floundered recently. And I think it's very attractive relative to a lot of its peers. The other 20% I'd put into REITs. And one of my favorite REITs right now is WP Carey. It's very well defensively positioned, has a BBB plus credit rating, one of the better ones in the triple net lease space. It's increasingly focused on warehouse and industrial properties, which are more in favor and likely to be more durable. They, again, offer a very attractive dividend yield, and they trade at a valuation multiple both on a price to NAV and a price to AFFO basis relative to many of their peers like Realty Income that are much higher. Their dividend yield is much higher, and their valuation multiples are meaningfully lower. So there's value there despite there being considerable quality. And again, they've proven their resilience in past recessions. I have no concerns about their ability to withstand an economic downturn. Another place I'd deploy another fifth of the portfolio is into infrastructure. And there are a lot of attractive infrastructure businesses right now. One of my favorites is Brookfield Renewable Partners. The business is growing fast. Management expects to grow to 10% plus FFO per unit CAGR for the foreseeable future, grow the distribution at a 5 or even a little bit higher percent CAGR for the foreseeable future. They have about a 6% distribution yield. They have a BBB plus credit rating, which compared to other renewable yield codes, that's amazing because all the rest are junk rated. They have a lot of liquidity, very well laddered debt maturities. Their contractual increases on their power purchase agreements, the vast majority of them are linked to inflation. And so they're well positioned again for any kind of economic environment. But I do think interest rate cuts are going to benefit them a lot, and they would withstand an economic downturn quite well. They recently signed an agreement with Microsoft to generate a lot of power for them for their AI investments and growth, and so that's another very promising growth vertical and a big vote of confidence in that company. Finally, I would put the remaining 20% into regulated utilities. I think that that's a great opportunity right now. I recently did a video about utilities as well, expressing the bullish sentiment for them, so you can check that out. So I won't regurgitate it all here, but bottom line is my favorite utility right now that I think will benefit from declining interest rates is ATCO. And it's a Canadian utility. You may not hear much about it, but it has a very impressive long-term dividend growth track record, well over a quarter century. Dividend Aristocrat effectively has a nice dividend yield of well over 4%. That's very well covered by earnings, very low payout ratio. It's growing at a very aggressive clip. Its earnings per share. It has a stellar crown jewel core business. It's through a stake in Canadian utilities, very defensive, highly regulated assets. But it also has some exciting growth verticals of structures and logistics business as well as a ports business. And those are driving a lot of its attractive growth. And so between the combination of the two and its very strong balance sheet, it's set up to grow while also being very defensive and paying out a nice and growing dividend yield. And the value here is so much that if you take out the current market value of its Canadian utilities stake, it's trading at like a 1 to 2, basically a 2 times earning multiple of its other growth verticals that are growing very rapidly. So it's clearly very discounted relative to other utilities or even just on an objective basis. And so that's why I like ATCO a lot. I've owned it for a while. It's been doing great lately, but I think it has further upside ahead, especially if rates do come down. So there you have it. Those are the places I'd allocate new money coming in today. Hopefully this video is helpful for you. Again, if you liked it, if you could please help me get to 3,000 subscribers, I'd greatly appreciate it. Give this video a like. Let me know in the comments below what you like, what stocks you like right now. And most of all, please subscribe to my channel. Thank you very much. See you next time.